Somewhere between childhood and your first paycheck, you absorbed an entire operating manual for money. Work hard. Save. Buy a house. Go to college. Avoid bad debt. Nobody sat you down and taught it in one lesson. It arrived in pieces, from parents, teachers, and a culture that repeated it so often it stopped sounding like advice and started sounding like fact. Here's the actual lie, and it's bigger than any single myth on that list: the manual was never wrong, exactly. It was written for a different economy, decades ago, and nobody ever sent the update. By the end of this video, you'll have gone through 10 of the most widely believed financial beliefs in America, one after another, and you'll understand exactly which parts of each one still hold up, and which parts quietly stopped being true while everyone kept repeating them anyway. Some of what you're about to hear will feel obvious in hindsight. Some of it will genuinely rearrange how you look at your own bank account by the time we're done. Start with the one that feels the most sacred: work hard, and you'll get ahead. It's less an opinion than a national religion, the closest thing America has to an unquestioned first principle. Harvard economist Raj Chetty decided to test it directly, tracking something simple: whether children ended up earning more than their own parents did at the same age. Among Americans born in 1940, 92% did. It was practically guaranteed. Among Americans born in 1984, that number had collapsed to 50%, a coin flip, no better than chance. Hard work didn't get lazier in that 44-year stretch. Nobody's grandparents were secretly working harder than today's 20-somethings clocking 60-hour weeks at 2 jobs. The relationship between effort and outcome simply got looser, buried under decades of rising costs, slower wage growth, and an economy that stopped automatically converting the first into the second. This doesn't mean effort stopped mattering. It means effort alone stopped being sufficient, and the manual never updated the promise to reflect that. Save your money, the second belief, is true and dangerously incomplete at the same time. Cash that sits still doesn't hold its value. It loses to inflation every single year, quietly, without a single transaction ever happening, the way a photograph left in the sun fades a little more every year without anyone touching it. Saving isn't the mistake. Believing that saving alone, with no destination beyond a static balance, counts as a complete financial plan, that's the part of the manual nobody revised. A savings account is a parking space, not a destination, and too many people have been told to park there permanently. Buy a house, they said, because renting is throwing money away. Owning can absolutely build wealth over time, and for a lot of people it genuinely has. But a home purchase carries costs almost nobody factors into the fairy tale: a real estate commission and closing costs that can eat up roughly 10% of the sale price on the way out, ongoing maintenance that typically runs 1 to 2% of the home's value every single year, and years of reduced flexibility to move for a better job across town or across the country. Renting isn't automatically throwing money away. Sometimes it's correctly pricing in a flexibility that a 30-year mortgage simply doesn't offer, and calling that decision wasteful was never based on actual math. Good debt versus bad debt sounds like a clean, tidy rule you can apply without thinking twice about it. It's really a trap disguised as wisdom. A mortgage gets labeled good debt because the asset behind it tends to appreciate over time, and a payday loan gets labeled bad debt because it obviously doesn't. That label means absolutely nothing the month you can't make the payment on either one. Debt isn't good or bad based on the category a textbook assigns it. It's manageable or unmanageable based on whether your income can service it when life goes sideways, a job is lost, or a health crisis hits without warning, and plenty of textbook good debt has foreclosed on plenty of houses anyway, long after the label stopped mattering to anyone. Pause here for a second, because these first four beliefs rarely operate alone. Picture someone who followed every one of them, in order, exactly as instructed. Worked hard through their 20s, assuming effort alone would compound into advancement. Saved diligently in a basic account that paid next to nothing. Bought a house at the top of their budget, trusting the math would sort itself out later. Took on the mortgage without hesitation because everyone agreed it counted as good debt. By their 40s, that person often finds themselves confused and a little ashamed, wondering what they did wrong, when the honest answer is that they did almost everything the manual told them to, and the manual itself was the part that was out of date. Job security, the fifth belief in that same manual, describes a world that's largely gone. Median time spent with a single employer in America has fallen to just 3.9 years, the lowest figure recorded since 2002, and it's still trending down. Ask a room full of retirees about their careers and you'll hear about pensions and 30-year tenures at the same company. Ask a room full of 30-year-olds the same question, and the honest answer is closer to a resume with 4 or 5 employers already on it. The one employer, one pension career that job security was originally describing has been gradually replaced by something closer to a series of temporary arrangements, regardless of how loyal or hardworking any individual employee happens to be. Loyalty didn't stop working. The system that used to reward it mostly stopped existing. College guarantees success carries a real average behind it, and averages hide almost everything that actually matters. Americans currently owe close to $1.9 trillion in student loan debt, spread across more than 40 million borrowers, more than every other category of consumer debt in the country besides mortgages. The typical bachelor's degree leaves a graduate owing somewhere around $30,000. But that single average blends engineering and nursing majors earning enormous, fast returns on their degree with other paths that leave graduates owing 6 figures for credentials that never translate into 6-figure salaries, sometimes never translate into a job in that field at all. 2 people can walk across the exact same graduation stage, diplomas that look identical, and step into financial futures that have almost nothing in common with each other. College isn't a guarantee, and it never was one. It's a bet whose odds change enormously depending on which specific bet you actually place, a distinction the blanket advice to just go to college never bothered to make. Inflation gets treated like a headline event, something that happens during a crisis and then politely goes away once the news cycle moves on. It never goes away. It's a permanent background tax on every dollar you're not actively putting to work, running in years when prices feel calm and years when they don't, whether or not it ever makes the evening news. The manual said prices go up sometimes. The truth is prices go up constantly, and treating that as an occasional emergency instead of a permanent condition is exactly why so many people get caught flat-footed by it, year after year, as if it were a surprise each time. Then there's compound interest, wrapped around maybe the most famous fake quote in all of personal finance. You've almost certainly heard that Einstein called it the 8th wonder of the world, or the most powerful force in the universe. He never said it. The phrase doesn't appear anywhere in his enormous collected papers, and researchers who've traced its origin can't find it in print anywhere until decades after his death, showing up first in financial sales materials rather than in anything Einstein wrote or said. It's a myth wearing a scientist's name for credibility it never earned. Here's the twist, though, the math underneath the fake quote is completely real, and the actual myth people believe about it is different from the misattribution. Most people assume compound interest rewards a high return above everything else, so they chase the hottest stock, the highest advertised rate, the flashiest opportunity. It actually rewards time far more than it rewards rate. A decent return held for 40 uninterrupted years will almost always outgrow an excellent return held for 10, which is exactly why so many people undermine their own compounding, not by picking badly, but by quitting, pausing, or cashing out years before the curve was ever given the chance to bend upward. Notice the pattern by now. Every myth so far has the same shape, the piece of advice that was directionally right, attached to an assumption that quietly expired. That pattern holds for the final two beliefs on this list as well, and they might be the two most misunderstood of all. Wealth versus income might be the most quietly damaging confusion on this entire list, because it hides behind a paycheck that looks like proof of success. A surgeon or an attorney can earn an enormous salary and still carry a negative net worth, one student debt, a mortgage on a house that's bigger than they need, and 2 leased cars get subtracted out. Financial planners have an actual term for this exact profile: high earner, not rich yet. Income is what arrives in the account. Wealth is what's left standing after everything else gets paid, and a big number in the first category guarantees absolutely nothing about the second. Plenty of people look successful on an income statement and would fail completely if you asked to see their balance sheet instead. An assets versus liabilities, on paper, sounds like basic accounting, the kind of thing you'd expect to be settled and boring, a definition you learned once and never had to think about again. In practice, a popular and genuinely useful shortcut for thinking about it cuts through the textbook definition entirely. Does this thing put money in your pocket every month, or does it take money out? A rental property that generates income is doing the first job. A primary home, once the mortgage is paid off, at least stops taking money out, even if it never technically produces a cent of cash flow itself. A car payment, a boat, a closet full of things bought specifically to impress the neighbors, is doing the second job relentlessly, month after month, for as long as the payments last, regardless of what column a textbook would technically file it under. Line all 10 of these up, and the actual biggest lie comes into focus, and it's not any single item on the list. It was the idea that these rules form a complete, permanent system, something you could learn once in your 20s from a parent or a teacher and trust unchanged for the next 50 years without a single update. They don't work that way, and they never really did. Every one of them was calibrated to an economy, a job market, and a cost of living that have all shifted substantially since the advice was first handed down, generation to generation, and the advice itself never got revised to match the world it was describing. Nobody lied on purpose. The manual just got old, and everyone kept teaching from the same edition anyway, because it was the only one they'd ever been given. So what do you actually do with 10 broken assumptions at once? Stop treating any of them as a rule and start treating each one as a variable you personally check against your own numbers, your own city, and your own timeline, rather than a slogan that's supposed to apply equally to everyone who's ever heard it. Run your own math on renting versus buying instead of trusting a slogan handed down from a completely different housing market. The math changes by city, by interest rate, and by how long you actually plan to stay, and a 5-minute calculation beats a decades-old proverb every time. Separate your income from your net worth and track the second one specifically, at least once a year, since it's the only one of the two that measures whether you're getting ahead. A rising salary next to a flat or shrinking net worth isn't progress. It's a more expensive version of standing still. Ask what a specific dollar of debt is financing and whether your income can service it if circumstances change, rather than sorting it into good or bad from a list and moving on without a second thought. The label on the debt matters far less than your ability to make the payment during the worst month you can realistically imagine. Treat your career the way the job market now actually treats you, as a portfolio of transferable skills rather than a single loyalty to one employer. That doesn't mean abandoning commitment. It means not building your entire sense of security around an arrangement that, statistically, now lasts under 4 years on average. Before committing years and tens of thousands of dollars to a specific degree, look up the actual employment and starting salary data for that specific major at that specific school, not the general reputation of having a degree. The data exists, publicly, and almost nobody checks it before signing the loan paperwork. And measure every financial decision by how long it lets your money keep compounding, not by how good the headline growth rate sounds this year. Time, not returns, is still doing most of the actual work, exactly like it always has, regardless of which scientists may or may not have said so. None of this means the manual was a scam, and none of it means the people who taught it to you were wrong to believe it. Most of it came from people who believed every word, because for the specific economy they grew up in, a lot of it genuinely was true, tested and proven across their own working lives, in real time, with their own money. It just stopped being universally true a while ago, one shifted assumption at a time, and nobody printed a new edition to replace the old one before handing it down again. You just did. Right now, by sitting through all 10. The version of these rules you carry forward from here doesn't have to be the one you inherited without ever opening it up to check. It gets to be the one you actually read the fine print on, tested against your own numbers, and chose on purpose, which is the one advantage nobody in the previous generation actually had, the chance to see all 10 myths laid out side by side, at once, before spending 40 years finding out the hard way, one at a time.